Hello and welcome to Portfolio Matters Weekly Update, Week 42. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what is our haul of charts this week?
Thank you, Richard. Okay, so this week we've had a warning from the new chief economist at the Bank of England, Hugh Pill, that he sees danger of UK inflation going above 5% in the coming months. And the market is all of a sudden starting to price in interest rate rises in the UK and the US. And going through some economic data from this week. So there was a lot. Okay, so the US Philadelphia Fed Manufacturing Index fell to 23.8 in October. That is well down on the 30.7 seen in September and was below consensus expectations. Now, you'll be aware from previous weeklies that we are fully expecting a slowdown in manufacturing due to rising energy and commodity prices and huge supply chain disruptions. But hopefully that will begin to clear next year. Okay, so US retail sales month on month in September were 0.7, which was down from August, but massively beat expectations. The expectations were for a contraction. If we exclude autos, retail sales were up 0.8%. US industrial production in September year on year was up 4.6%, which was down from August and missed expectations. Month on month, it fell by 1.3%. And in August, it only fell 0.1%. And that was a massive miss from expectations. But frankly, I think the expectations were all wrong. Given the supply chain disruptions, etc., I think it was inevitable that industrial production suffered. But once those supply chains disruptions passed, that should recover, hopefully. So US existing home sales rose to 6.29 million in September, well up from August and beating expectations. Now, in the UK, we had public sector net borrowing for September, which came in as net borrowing of £21.6 billion, which was better than expectations. So the market was expecting 24.4 billion. That still seems an absolutely enormous number for me, but that was better than expectations. The market took it well. We'll show you a chart in a minute.
Keith, can I just interrupt here? So this is interesting. I've just been doing a sum in my head. If you assume that there's 150 million homes in the US, doesn't seem unreasonable with a population of 300 million, then turnover of 6 million a month. Is this annualized or is it annualized?
No, I don't think it is. The thing is, these numbers do puzzle me as well, Richard, because
that means the average holding period is about 15 months.
Yeah, because the housing starts 1.55 million a month. You know, that seems absolutely extraordinary to me.
Yeah. Okay, we better carry on, but just
yeah,
something odd about those numbers.
There is something odd about those numbers, and perhaps one of our US viewers could explain them to us.
Yes.
Okay, UK business orders fell heavily in October. This is an index, so it fell to 9 from 22 in September, massively missing expectations. Now, we had UK inflation numbers, and inflation actually dipped to 3.1% in September from 3.2% in August. But frankly, everyone is expecting it to shoot right back up in the next few months. Core CPI was 2.9%, which was down from 3.1% in August. UK retail sales year on year fell 1.3%. Now, I take that to mean that now that lockdown is over, people are spending more on services and less on goods. In China, we had industrial production numbers, and in September, they were only 3.1% year on year, well down from August and missing expectations. Retail sales, though, were strong, up 4.4% in September, up from 2.5% in August, and massively beating expectations. So that is good. In the EU, inflation continued to run hot. It was 3.4% in September, up from August, but matching expectations, and core inflation was 1.9%.
And can I just chip in there, Keith, to say the definition of core inflation is the inflation rate of items that don't exhibit any inflation, and is therefore a singularly useless measure.
Yeah, you are cynic, Richard. The EU consumer confidence is turning over, and it's fell to minus 4.8 in October from minus 4 in September. But we'll show you a chart in a minute, and it's something we've commented on before, that consumer confidence in Europe is never very good. And these are actually quite decent numbers. We also had some quarterly data. And the UK Business Optimism Index took a total bath actually for this quarter, Q4. It's fallen to 2 from 27 in Q3 and massively missed expectations. So the rising energy prices, supply chain disruptions, unsurprisingly, have caused a big drop in business optimism. Now, in China, we had Q3 numbers. So Q3 GDP growth annualized was 4.9%, which is respectable. Quarter on quarter, though, it was only 0.2%, which is frankly terrible and worrying. And capacity utilization fell to 77.1%. So we're getting more indications of a slowdown in Chinese manufacturing. Okay, so this is a chart of Chinese GDP growth, and you'll see that, as you would expect, as the Chinese economy gets larger and larger, it becomes difficult to sustain very strong GDP growth. And GDP growth is slowly declining, but again, is just much better than anywhere else in the world. And China remains a key driver of global economic growth.
But with the slowdown in the Chinese housing market that we're all anticipating, that GDP, which is 30% of the Chinese economy, that GDP growth is likely to substantially fall, I would say. And if it doesn't, I would be very suspicious.
Yes, I would agree with you there, Richard. We'll show some more charts on China in a minute. Okay, so US continuing jobless claims. This is a very good picture. So we're seeing strong employment growth in the US. These are initial jobless claims, again, consistent with a strong US employment market.
Just like to point out with these graphs that the x-axis isn't at 0 on the y.
Yes.
It doesn't intersect at 0, it intersects at quite a high number. So the absolute figures, the relative numbers are slightly distorted by this type of chart.
Okay, UK CBI Business Optimism Index, and it is rolling over, sadly. UK industrial orders are falling, so not a very happy picture of the UK manufacturing sector. But US housing starts have been on a steady upward trend since the financial crisis, essentially. And US home sales are picking up. I mean, Richard's right. These are extraordinary numbers. I don't quite understand.
No.
And UK inflation ticked down briefly, but everyone's expecting it to start rising again from next month. EU consumer confidence fell, but actually remains very high at, minus 4.8.
They're clearly just endemically miserable, Keith.
Yeah. You'd think, Italy must be one of the best places to live in the world.
They should rebase this chart at -10.
Yeah. UK consumer confidence. Well, we're not doing much better.
No.
Moving on to UK public sector net borrowing. So it actually came in better than expected in September, but you will see we have a structural break at the COVID pandemic. And now we have a massive increase in public sector borrowing, and that needs to be fixed medium term if the UK is not to have a debt crisis.
And the headline was UK borrows less than expected, but it was the net borrowing, not the absolute borrowing, which the headline is slightly misleading. And the absolute level of debt is continuing to rise at an alarming rate.
Yeah. And these are numbers in just this morning. This is the flash PMI for October, and it is drifting off, but is still actually remarkably strong given all the headwinds that European manufacturers are facing. Okay, moving on to Inflation Watch. Well, we've now updated the table for September. So we have all the data for all the countries in the table for September, and Germany's CPI has crept up to 4.1%, and everywhere inflation is much higher than the 2% target, apart from in Japan, where it's essentially still close to zero. And everywhere interest rates are rock bottom, and they're still doing QE. And just to reiterate the point that monetary policy is incredibly easy, historically, there has been a link with a tight jobs market in the US and US monetary policy. When the jobs market is tight, as evidenced by the small business jobs hard to fill survey, which is the light blue line, then you tend to see rises in interest rates. Well, not this time. The small businesses are reporting that it is harder to fill jobs at any time in the history of this chart, 25 years. And the Fed is not only has interest rates at zero, but they're still doing QE and pumping money into the economy. But the market is now expecting that the Fed will start raising rates. But look at the x-axis. They're talking about 2 rate hikes by February 2023, so a rise of 0.5%.
Mm-hmm.
Bear in mind that US CPI is now 5.4%. In 2 years' time, interest rates will be 0.5. In the UK, they are pricing in 4 interest rate rises next year.
Yeah.
Now, in Germany, PPI, so producer price inflation, is 14.2%, CPI 4.1%, and Germany used to be the home of hard money. Well, their hard money is eroding.
There's only one direction in which German CPI is going to go, isn't there, Keith?
Yeah, absolutely.
And
now we've updated our food price index from the UN Food and Agricultural Agency, and I'm afraid it is creeping back up. So it did dip in July and August, but in September and October, it has come right back up and is now at new highs. If you look at the components, it's broad-based, so everything is rising. And as we've talked about before, that is really bad for poor countries where people spend a lot of their income on food. And back in 2011, that was one of the big causes of the Arab Spring and civil unrest. So watch this space.
The other interesting about this, Keith, is just sort of eyeballing it. And it's quite tricky to sort of get it, but as a rough sort of estimate, these prices look like they're up about 20%. since the charts began, with some of them up substantially more, vegetables up substantially more. And food price rises of 20% over the last 12, 13 months simply doesn't tally with the inflation rates that are being reported. I understand that food is only a subcategory of inflation, but in terms of what the experience is of moderately paid individuals, the inflation they're experiencing is hugely greater than the reported rate of inflation.
Well, actually, while we've got this chart up, vegetable oils, how much of that is caused by vegetable oils going into biodiesel?
Exactly, yeah. And cereals being used for fermentation to produce ethanol.
Yeah. Now, this chart is quite old, but it shows the various components of US inflation over the 20 years to December 2017. And it shows a really stark picture. So hospital services over that 20-year period went up over threefold. And the general picture is of enormous increases in service price inflation, offset by big declines in manufactured goods imported from China. So TVs, the price of huge TVs totally collapsed. And so overall inflation was up 55.6% over that period. But your personal inflation would depend very much on whether you consumed more services or more manufactured goods. So this week, I just want to talk briefly about the 60-40 equity bond portfolio, which has been a staple of the recommended asset allocation for investors for a long time now. And the idea being that this is the optimal portfolio for risk reward. And these figures all use the ETF, so 60% in the Vanguard total stock market, US large cap, and 40% in US bonds. And it has had an absolutely extraordinary run, essentially. Over the last 25 years, you'd have had annualized returns of 8.3%. And if we move on to, so this is the performance over that period. So you've done incredibly well. And when you look at the worst drawdowns, I mean, really, this is an extraordinary table. There haven't been that many big drawdowns. You can basically run through these. The top one is the Great Financial Crisis, the dot-com bust, COVID pandemic, Asia crisis. Was that the taper tantrum? Was that taper tantrum? Anyway, there weren't that many big drawdowns. It's been an absolutely remarkable 25 years. And this is the distribution of returns. So, most you could have made in 1 year is 35%. The most you could have lost is 25%. And, when you look at this distribution of negative returns, I mean, there really haven't been that many big drawdowns. But regular viewers of Portfolio Matters will know that we have, since the start of the podcast, been hugely negative about bonds. And the point about talking about this is we consider the 40% allocation to bonds to be 40% too high, because bonds are going to systematically lose value as interest rates rise and inflation remains persistent. Now, last week, I said rude things about people who are buying UK 10-year and 30-year gilts at yields of 1.1 or 1.3% when inflation is above 4. And I actually had to beep myself in the edit. But I want to take that back and say and thank them for their sacrifice, because we need people to buy gilts at these ridiculously high levels to keep interest rates low and support the economy. And if any of you are watching, we thank you for destroying your personal wealth for the good of the rest of us. And please keep on doing it. But while advising Portfolio Matters viewers not to get involved.
Very good, Keith.
Okay, on to other charts. Well, global corporate earnings estimates are rising again, despite all the headwinds we're seeing, such as rising energy prices and electricity prices everywhere, and as evidenced by a deteriorating macroeconomic environment. So the white line is the Economic Surprise Index. And this, I'm warning you, this is a dodgy chart, but we thought it was quite interesting. So the dark blue line is the ratio of inflation to economic surprises. So you'll see that currently we're having much more inflation surprises to the upside than economic surprises. So that index is strongly negative. And historically, the light blue line, which is the MSCI World Equity Index, year on year has tended to follow the ratio of inflation to economic surprises. And if that continues, then you'd expect equity markets to take a bath.
Yes.
Richard, do you want to take over?
Thank you, Keith. So the German year-ahead power price, which we've mentioned in the last few podcasts, is basically continuing its huge surge upwards. It's risen since the start of the year. It's risen 300%. And obviously this is looking 1 year ahead. But clearly for businesses that buy energy forward, so high energy consuming businesses, this input cost has gone up dramatically, and it's bound to come through in manufacturing costs, PPI, and consumer inflation at some point. And meanwhile, credit conditions in China are tightening, and the all of these indicators, so the shadow credit, which is in red, the government bonds in light grey, and the bank loans, corporate bonds in the beige, credit growth of all of those, well, the credit growth is declining for all of those. Now that is government policy, I believe, because the government is very concerned about the level of debt in the Chinese economy. And recently, Xi Jinping has emphasized the need that wealth needs to be spread across the country and not concentrated in a few individuals. And by tightening credit growth, I think that is one of the tools that he's planning on using to achieve that. And another one is the fairly draconian action that we've been seeing taken against large Chinese companies. So the net effect of that is that Chinese growth continues to slow. And it peaked after, it perked back up after COVID. And both retail sales and industrial production are on a continuing downward trend. And given that the property market in China in total is around about 30% of GDP, and we know the property market is beginning to slow, we also know that those numbers won't really have fed into these figures yet. The property market is looking like it is going to be extremely unwell shortly. And the effect of that on the Chinese economy is difficult to discern, but won't be good. Some commentators say the effect of it on the world economy will be limited. I suspect that is not true. And the Chinese property developers' bonds have tumbled from, in 3 to 4 months, they've tumbled from 650 to 400, so that's like a 30% drop. They have ticked up very slightly in the last week or so, which suggests that some investors think that the damage to the property sector has occurred and won't persist. I think the jury is out on that.
Or people know something about Chinese policy. Yeah. So actually, when you look at previously, Actually, it did bounce back quite strong. This is obviously in the depths of the COVID epidemic then.
Yeah, whether there's the government might in fact step in and support these companies so they don't actually default.
So this is the chart of the performance of Chinese ADRs in the US relative to the S&P 500. And you'll see that actually they have serially underperformed the US market as a whole for a long time now. And in particular this year, when the Chinese government, as Richard has said, have been cracking down on large tech firms, they've essentially massively underperformed. Their performance has been... Actually, they've lost half of their value relative to the S&P. Now, moving on, in economics, there's a concept known as the tragedy of the commons. So if there is no clear title to a property, then everyone has an incentive to exploit it as quickly as possible because it's a finite resource, nobody has clear ownership, and you can try and get as much of it as you can before everyone else takes their share, essentially. And this is 5 centuries of cod catches off eastern Canada. And what you can see is in the 60s and 70s, when essentially fish radar came in, the trawlers just took out all the cod to the point where the cod populations couldn't regenerate. And then you had the regulator coming in saying, right, you're not catching any more because the cod stocks need to recover. And the sad truth is they're taking a very, very long time to recover.
But this is it's a similar concept. This was in the Financial Times. The banks pump 119 billion into deforestation-linked deals. So this is where the corporate world actually takes no responsibility for the consequences of its corporate activities. And so not only, as it mentions here, the carbon emissions, deforestation is linked to a major source of carbon emissions. It also, of course, is linked to a major source of non-carbon absorption. And when done on a large scale, causes significant climate change to the extent that quite possibly when reforested, the climate doesn't actually recover to that sort of rainforest type environment. So we have this sort of rapacious corporate culture around the world, which pays no price for destruction of the environment. And the other thing I'd like to comment on here is there's clearly huge pressure on world food supplies. We've seen food price inflation. Why would there be major deforestation in order to allow agribusinesses to grow food? And one thing that nobody mentions when talking about ESG and the environment is the global population. And it is my view that the global population needs to fall in order that we create over time, in order that we create a sustainable human population on this planet. And I think that is a crucial discussion that nobody's willing to have.
Absolutely. So one point that I failed to mention regarding the cod is it shows the crucial need for regulation, as does Richard's point about deforestation. Okay, moving quickly on to COVID in the UK, and I'm afraid that the numbers aren't terribly encouraging, and UK viewers will have been hearing that people on the radio asking for return of lockdown, etc., etc.
However, I think it's important to bear in mind, Keith, that the high rate of infection is amongst children who are generally speaking not severely affected by COVID. And as this chart shows, the daily deaths are not increasing significantly. And if the next chart shows the hospitalization rates, which likewise aren't actually going up, and that would be due to the effectiveness of the vaccination program. So the question is, why should we have a lockdown, or if we are not experiencing an increase in patients admitted to hospital and an increase in the death rate? That is the question I would pose.
Well, the thing I'd say there, Richard, is the debate has been on the modelling of what's going to happen in the winter period, and they're all extrapolating things upwards. But a reminder, lockdown is not good for people's mental health. So, you know, the big drops in people's happiness and life satisfaction and increases in anxiety due to lockdown. And on my part, it causes intense irritation.
I think lockdown is an inherently incredibly bad thing for us. And I think that organizations that call for lockdown irresponsibly, and I think some of them are being irresponsible, need to be careful. But it is also true to say that the NHS is under huge pressure.
Yeah. Yes, agreed. Okay, moving on to equity markets. Now, thank you to our long-time viewer, Bob Beattie, who asked us to put in year-to-date numbers on all our tables, and we have done so. Okay, so it was generally a positive week in equity markets. The all-share was the standout, in that it fell 0.4%. Stocks Europe was up 0.6%. The S&P had a great week, up 2.5%. NASDAQ was up 2%. Japan topic index was down 1.1%. Bitcoin continued strong, and Richard will have a lot to say about that. Up another 5.4% and up 116% year to date. Sterling had a good week, up 0.6% and is now up 1.2% on the year. Okay, so the linear chart of Ether shows that it just poked through its all-time high set in May of this year and then fell back, but it is on a looks like it's regained its upwards trend. And the log chart, I've actually put two lines on the log chart. The next chart, please. I put a long-term log line, which shows that it's actually quite a long way above its log trend, and I put a shorter-term log line, which shows it's actually growing price is going very nicely on a log trend. Now, Ether is being increasingly used, as we've discussed before, for non-fungible tokens, and the pool of Ether available for people to buy is actually only about, I think, 10% of the total Ether supply. And the Ether supply is going up by about 1.5% per year. So there is potentially a significant possibility of a squeeze on the price of Ether. And these non-fungible tokens, which you will have come across, many of them do require Ether to function. So the explanation for the rise and a potential continual rise in the price of Ether is due to that. The chart of Bitcoin, interesting thing about Bitcoin is that although it's up 116% year to date, had you bought it when it was in say mid-April, you would only be very slightly up on the year, but you would probably have sold it because it halved in the process. And this just illustrates the huge volatility of these. And either you have to be quite nippy in getting in and out, or you have to have a small element of your portfolio dedicated to them so that you don't mind holding them. But they are a very difficult thing to, because of the volatility, they're a very difficult thing to hold. Sound advice.
Keith is, this is a Bitcoin mining chart that Keith discovered. Last few months have seen a massive change in where Bitcoin is mined, and mainland China don't do anymore. And it's all moved. A lot of that slack has been taken up by the US. And was there something else you wanted to say on this, Keith?
Well, actually, I'm quite impressed by Bitcoin's resilience. That is a lot of disruption, actually. So you're talking about, was a end of last year, almost 65, 70% of Bitcoins being mined in China is now zero. Yeah. And the system has proved resilient. So that's actually quite impressive.
And this is a chart of gold and Bitcoin. Clearly, Bitcoin has slightly outperformed gold. And in fact, the problem with Bitcoin is so huge that it swamps any movements in the gold price anyway. And there's this debate as whether Bitcoin is a substitute for gold. Personally, I don't think it is, but there are people who do think it is.
Mm.
And Keith's favorite chart or illustration, a carbon footprint of Bitcoin, which is large.
I find this absolutely astonishing, because you know how much energy goes into mining an ounce of gold. You're talking about, gold concentrations of a couple of grams a ton. So you have to process tons of rock to get out an ounce of gold. And yet Bitcoin is 15 times more carbon intensive.
It does need to be changed, doesn't it?
Mm. Okay, so this chart shows the overvaluation of growth stocks in the US. So this is the percentage of growth companies in the Russell 3000 that have negative earnings, and it's at an all-time high. Although, frankly, GMO, who produced this chart, define which stocks are growth stocks, but still. So this chart shows rolling monthly returns for the period 1926 to 2021 for the S&P 500. And it shows if you hold stocks for the long term, then that has almost always been a good bet. So over every 20-year period, over those best part of 100 years, 95 years, you would have made money. Over 99.8% of 15-year periods, you would have made money. But only in only 63.1% of monthly periods would you have made money. Moving on to industrial commodities, and it was a very mixed week. So aluminium came off by 4.4%, although it remains up 50% on the year. Cobalt was up 0.4%, up 74% on the year. Copper up 0.8%. It's come off in the last couple of days, but it's still up on the week. Up 0.8% on the week, up 30% on the year. Chromium was flat, but up 60% on the year. Iron ore had a little bounce from its lows, but because of the Chinese crackdown on steel production, the iron ore price is actually down 27% so far this year. Lithium had a great week, up 10%, although we should warn you that our data source for lithium seems to fly around. So when I was updating this chart, I noticed that the data for last week had actually been amended. But anyway, it's now showing a return of 10% last week for a return of 290% year to date. Neodymium was up 3% and up 130% on the year. Nickel up 6%, up 25% on the year. Tin is up 0.5%, up 83% on the year. So it's been an absolutely extraordinary year in commodity markets. Ferrum and vanadium was flat, but up 23% on the year. WTI, the US crude future, was up 0.5% on the week, having had a volatile week. And it's up 70% year to date. And Dutch natural gas futures, thankfully, have come off their enormous peak. So they fell by 14% this week, but they're up 360% year to date. And that is going to cause enormous damage to European industry if that persists. And we have to hope that the market will continue to heal and gas prices will come back down. Coal, likewise, falling 6.7% on the week, but still up 184% year to date. And uranium, finally, up 2.8% on the week and is resilient, and that's up 59% year to date. Thank you once again to Bob Beattie for asking us to put in year to date numbers. Richard.
This is just a little extract from an article in the Financial Times by Jeff Curry, the Global Head of Commodities Research at Goldman Sachs. which he says, if policymakers' goals of broad-based prosperity and a massive build-out in green infrastructure are to be met, commodity prices will need to significantly overshoot to the upside to provide the incentive for investment. This is needed to compensate for the growing risks involved in long-cycle capex projects and the inherent complexities surrounding the green energy transition. As we argued a year ago, a new commodity supercycle is upon us. And I think, no, upon us as opposed to over, halfway through. We are in it. And I think that is very important for those of you who are interested in commodity investing.
Yeah. Because the thing is, what we're seeing is an excess of demand over supply. And you know that supply takes a very long time to come through, because if you want to increase copper supply, you need to develop a new mine, and that will take you literally years, like 5 to 7 to decades. So I think he's right.
And this is a chart that Keith found. Energy capex has declined as ESG concerns rose. But of course, we need energy capex as we still need fossil fuels for our energy source, because we haven't yet substituted for them. And the raw materials inflation index is at a new all-time high. Is that right, Keith?
Yes, that's right.
Commodity index, yeah.
So Jeff Curry, you know, this isn't the end of it if he's right. Yeah,
that's right. And now the price of magnesium delivered to Europe has shot up. It's doubled in the last month or so. And as it says here, magnesium strengthens aluminium and is an essential ingredient in aluminium sheet, lightweight, because it enables you to use far less aluminium for the given strength.
So what is aluminium billet? Well, these are aluminium billets, and this standard way in which aluminium is delivered. And the interesting thing is that you make aluminium through an electrolysis process that is even more electricity intensive than the aluminium manufacturing process. So to produce 1 ton of magnesium, you require 35 to 40 megawatt hours of electricity, compared to 16 megawatt hours for aluminium. And as the Chinese government has been cutting down on power usage, so it has ordered lots of magnesium smelters to reduce their production. As a result, there is a global shortage of magnesium, which will have knock-on effects for the availability of aluminium, and that will affect all sorts of manufacturers, particularly aircraft and car manufacturers. So crude has had a great run recently, but was flat this week. And if we look at US crude oil and petroleum inventories since the start of the pandemic, there was an initial huge build in inventories as everyone was locked down and couldn't use their cars and manufacturing closed down. But then since lockdown has eased, we have now completely used up that excess inventory. As a result, inventories are below their 5-year average, although they have been increasing last couple of weeks in line with seasonality. Now, this is a chart from the EIA, which shows their proposed path to zero carbon, zero emissions. And just look at the green bar at the bottom here, batteries. They're essentially forecasting you need to go from very few batteries now to batteries being 60 to 70% of the energy supply going forward. It's just absolutely ludicrous. Where are you going to get all the metals for that?
It's feasible over a long period of time, but over the next 10 years,
yeah,
it makes no sense.
And we're already in 2021, you know,
I know.
Nowhere near on this path.
No.
It's silly. Now, last month,
So I was going to never mind where all the electricity is going to be generated from.
Yeah. Coal, Richard. So this is OPEC plus oil production, and last month it grew by actually an enormous 700,000 barrels a day. So that, remember that they're meant to be increasing by 400,000 barrels a day, OPEC plus, month on month. And all of that came from Saudi Arabia, UAE and Kuwait, which are the few members of OPEC who have spare capacity. But if Saudi Arabia's got all its spare capacity, how come its crude inventories are falling? Something doesn't add up.
Mm.
Meanwhile, in China, I love this. It's like the Chinese government is one enormous hedge fund. So when the oil price collapsed back in January 2020, the Chinese government added loads of cheap oil to its strategic stockpile. And now that prices are high, it's releasing them. So that has been a great trade, but inventories in China are now coming down. But a reminder not to get too carried away about crude prices, because the EIA is forecasting that they will peak in December at around 81, which is kind of where we are now. And then they will drift down next year as the oil market goes back into surplus. But they're making quite big assumptions there about supply and demand, and we'll have to wait and see. And building on what Richard was talking about earlier, the yellow line is the Brent crude price, and the blue line is CapEx. So the CapEx of the 70 largest listed oil companies globally. And what you can see is that they're not increasing their CapEx. And unless they do, the oil price is going to be a big problem for the world.
And the interesting thing about that graph, Keith, is the degree by which the capex has dropped. So it's dropped from, let's say, 320 billion down to 120.
Yeah,
60-70% drop over the past 9 years.
Yes, that's true. But essentially, it's massively dropped pre-COVID and shows no sign of recovery.
Keith, a point on this actually, your oil services stocks, are they exposed to this decline in capex?
The answer, Richard, is yes, they are, essentially. And what's happened is that the oil service companies, their share prices are just not recovering. And the market seems to be assuming that this capex drop is permanent. And I just don't believe it is. It can't be permanent, because if it is permanent, then the tightness in the oil market is going to get worse and worse, and the oil price is going to go ballistic, and that's just would kill the world economy. Essentially, capex has to come back.
Yeah, good point.
So we get questions about is the run in energy equities, is there any juice left? Well, frankly, yes. So these are previous energy bull markets, and you can see it tends to be a parabolic curve. So we are here, the red line, and frankly, we have years to run.
And that ties in with Jeff Curry's comment as well, in terms of the super cycle only just beginning.
Yeah. Richard, do you want to do some charts?
Yeah. So aluminium has just fallen back from its peak, but it had risen very far, very fast. So I don't think that's surprising. Cobalt is maintaining its its price increase. It's still settling down between, I guess, $50,000 and $60,000 a ton. Copper is actually bouncing around, but it is fairly stable at this elevated level of that it's been at for the last 6 months.
And it's been an extraordinary week, actually, in copper markets, because we've had this, the LME have had to intervene in their copper market because they were running out of inventories, and they've had to mandate that people don't remove inventories from the LME. And you wonder, that's a temporary fix. It doesn't fix the underlying problem that people want a lot of copper.
No, it doesn't, does it? But it's interesting that the problem cropped up in the first place. Chromium is continuing its stupendous parabolic run. Iron ore, as Keith said, is now 29, I think it was, % down year on year. And you wonder what the Chinese, what the effect of a curtailment of Chinese residential construction is going to be on iron, since all those blocks of flats are basically built out of steel girder frames. Lithium price inexorably, steeply upwards. Neodymium seems to have stabilized actually at that price level. It's been around it for most of 2021 now. Although, as we have previously commented, there isn't really a shortage of neodymium, apparently. Nickel has had a good run. It's continuing to appear strong. And if you sort of draw a line by eye through the lows from May onwards, it has just about to touch that line, I think. Tin has continued its very strong run. Ferrovanadium, as we know, has come back, but seems to be settling around about the $30 a kilogram level. And Dutch natural gas, I mean, it couldn't keep going up like that, could it? It has come back down and remains to be seen where it goes from here. A lot of it, I think, is dependent on what happens to Nord Stream 2, about which there's a lot of political argument at the moment. And Keith, do you want to do these?
Yeah, so these were a couple of charts from John Kemp at Reuters, which are very interesting. They're talking about Gazprom's gas supplies to the West, to Europe, which are a fundamental cause of the tightness in EU gas markets. So this is gas supply to the EU, and you'll see that year on year, it's down roughly about 20%. From this time in last year. Whereas if you look at Russian gas supplies to Ukraine, they've completely collapsed. So if you go back 2 years, then gas supplies are down around about 70%. So frankly, this looks political to me.
Yeah.
Richard.
The price of coals, again, it was going up parabolically, and nothing can do that forever. And it has dropped back down. It's still well above the trend line that you could draw from June. And all the news is still very bullish for coal in terms of the shortages, the increasing energy demands, the lack of coal in India, problems in China. So I suspect the price of coal is not going to fall back very much further. This is a graph of energy use per person, which is really interesting. It's up to 2019, but it shows the United States is way out ahead of everybody else. But the interesting one particularly is where China lies, and it's suggestive that if China wishes to achieve its ambitions and also to maintain social cohesion, the energy usage per capita in China is going to have to continue to rise, probably up until it equates with somewhere between UK and Germany, I would think. And that suggests continuing demand for energy in China and continuing pressure on coal at the moment. So Indian electricity shortages. This chart shows the size of the daily shortage in millions of kilowatt hours. And in September, it was bumping along at around about 10. And suddenly in October, you had these vicious spikes where there are very large energy shortages in India, which have dropped back down now and to a level twice that of early September. It remains to be seen what happens from here, but we do know that there are problems with the coal supply in India, and they're very dependent on coal-fired power stations. And clearly, this has an effect on Indian manufacturing as well. And carbon emissions are at near record levels and will probably continue to rise as the world demands more energy and not less energy. And I think this also points to, I think there's increasing talk now about the use of nuclear power. And in my view, nuclear power is the only realistic way of bridging the gap between current fossil fuel consumption and renewable energy supplies coming on stream over the course of the next 15, 20 years.
Yeah, and I completely agree, Rich. And I think that has been a source of comment over the last few weeks as gas prices have gone through the roof, and you see the UK and Europe both talking about small modular nuclear reactors. But all these take a long time to bring on stream. So let's hope they get going.
Yeah, and I wouldn't be in the least bit surprised to see regulations easing off to enable these small modular nuclear reactors to be built more quickly. And here's a graph for uranium where it spiked up, dropped back down, and come back up effectively to the level to which it spiked. So that looks a pretty strong chart to me, particularly given the underlying reality of the situation.
Okay, moving on to precious metals, and silver had a great week. So gold was essentially flat, up 0.2% on the week. Silver was up 4.1%. Platinum up 0.3%. Rhodium was flat. Palladium fell 4.5%. But if you look on the year-to-date column, it's been pretty terrible, frankly, given that inflation's been rising. So gold is down 5.5% on the year. Silver is down 7.7%. Rhodium and platinum down in double digits. So not very encouraging. They are not doing what they're meant to do, which is providing an inflation hedge.
So I've put this chart of silver in, which shows that effectively it's in a range or very slight downtrend after its big spike up 14 months ago. And until it breaks through out above that line to about $28, there's no particular urgency to buy it, I would suggest. And same for gold. So there's a couple of extra lines on here, but you can see I drew in a sort of wedge-shaped pattern. And the price is still within the wedge. And again, I think if it breaks up above that downward sloping line of the wedge, then that may be an indicator that it is about to undergo a significant price rise, but it hasn't done so yet.
So, Richard, what package do you use to produce these graphs?
My broker package. Right. It's okay. And you can do simple charting.
Right.
Draw lines on and things like that. I don't use a charting package. So platinum has shown a little bit of life again in the last few weeks, although, you know, if aluminium comes along and curtails the auto manufacturing, then one of the major uses of platinum is in auto catalysts. That will fall away, demand will drop. Likewise with rhodium, which is really looking rather sad, as is palladium.
Yep. Okay, finally on to rates. And so the Bank of England is now talking about raising rates in the near term, possibly at the November meeting. And we discussed last week how bond yields had actually fallen last week. Well, this week they bounced back. So the UK 5-year yield rose to 0.8%, up 10 basis points on the week. In fact, the whole yield curve shifted upwards by around 10 basis points. Now, in the EU, Greek 10-year yields crept above 1%. And again, there was a rise of above 10 basis points in the yields of Greek, Italian, and Spanish bonds. But they remain below UK 10-year yields. So there's no evidence as yet of a return of the Eurozone crisis. And a reminder that the performance of banks and yields is very closely linked. So the white line is the yield on the US 10-year, and the blue line is the bank index versus the S&P 500. So banks tend to outperform when yields are rising. Okay, so this is UK 10-year. So after last week's blip, it has resumed its rise. And this is the price of the UK 2061 gilts. So it's got a 40-year duration. And its year-to-date performance in price terms is down 20%. So reiterating what we were talking about earlier about the 60-40 equity bond portfolio, if you're holding bonds in a rising interest rate environment, they will lose money. This is the US 10-year, which has resumed its rise. And finally, on to the seasonality chart. And we are now moving into a period where the market starts to recover strongly into the end of the year. You read it here first. Okay, Richard, how was your week?
So I had a moderately decent week. My portfolio up 1.3%, change for the year 12.1%, and the FTSE all-share change for the year 11.8%, so very slightly ahead against that. I had a quiet week, but I did buy some shares in Cameco, which is a Canadian or American even uranium miner. And my view is that there is a uranium bull market on its way, if we're not in it already. And I want to be part of that. And I think all the recent news about the small modular nuclear reactors, the huge deficit in power generation that we've discussed, and the desire to get rid of fossil fuels, and the inability of renewables to fill the gap, I think it's all very bullish indeed for uranium. So I have bought Cameco. And you'll see it's actually, I bought it at the recent high, which I'm sure is a silly thing to have done, but you have to get into these positions at some point, don't you? And that's what I've done. But it's going to be a long-term holding for me, so hopefully for several years. And that is the sum total of my activity this week, Keith. How about you?
Okay, thank you, Richard. Well, I had a poor week as oil and gas stocks, which have had a very good run, had a pause and actually came off despite the oil price continuing to be very strong. So I was down 1.3% on the week, and year to date, I'm up 13.9%, which puts me slightly ahead of the all share. Now, I only had one sale this week, and I sold a small chunk of my Royal Dutch Shell because, frankly, it's been a good performer and is my largest position, and it's getting to be too much of a percentage of my portfolio, and I wanted to fund some other positions. So that's been a good trade. I've made 41% on that so far. Now, having said last week, I wouldn't buy any more Rambler before they got their financing sorted out. I was unable to contain myself, and I added a small amount. And as you'll see, the share price has since drifted off slightly, so I probably got what I deserved. I've added some more to my i3 energy position, and last week we covered Diversified Energy, which had a negative documentary by Bloomberg on its methane emissions, and the share price crashed. Well, as they've recovered, I added a bit. And finally, like a dog returning to its own vomit, I have returned to Chariot Oil and Gas. We'll go into that. Right. Okay, so this is Rambler, and I bought it there, that little near-term peak. But, you know, during the week, it released some drill results, which were actually really good, I thought. There's a lot of copper down there in the depths of the Ming mine. And if you can just get its financing sorted out, I think that mine, Toby Badbury seems to have really got the drilling program and the stope mining, so increase the number of stopes they're mining, under control. And I think it looks good, but they need to get the financing sorted out. Now, one of the companies we have covered on Share Talk is Techmar, which does cable protection systems for the offshore wind market. And we covered it because before the pandemic, its shares were right up here, about £1.60. And obviously, there is a lot of investment going into wind and offshore wind in particular. So medium term, you would think that it has strong growth prospects. However, it has to execute. And this week, it had a profits warning on supply chain disruptions because it gets a lot of its components from China. And the share price has crashed about 15%, which is disappointing. And frankly, I think is a precursor to lots of other European industrial and manufacturing companies also reporting that they're having difficulties from supply chain disruptions. So watch this space. I added a bit to i3 Energy, which I really like, and we've done a share talk on, so please watch. Diversified Energy, we talked about last week, and I added a bit. I wasn't brave enough to get in when it was a falling knife, though several of our Discord members did, and good luck to them.
Good for them.
But, it's recovering, and they are holding an investor conference and promising to do something about the methane leak. So you'd hope that medium term it will get back to drifting steadily upwards.
Good.
And finally, Chariot Oil and Gas, which has now embraced the energy transition and renamed itself Chariot Limited, although it still has enormous gas fields offshore Morocco. And I have a sad history with this company in that it had lots of good prospects back in the day offshore Namibia and Morocco, and it drilled a series of dry holes which basically collapsed the oil price. But the Anchois development offshore Morocco, it is now drilling an appraisal well, and coincidentally, it has got into a big spat with its neighbor, Algeria, and Algeria provides a lot of its gas piped through in transit to Spain. So the Algerians are threatening to cut off supplies to Morocco and hence to Spain. And you would hope that this incentivizes the Moroccan government to actually allow the acceleration of the Anchois field development. So I have bought back in more for me. Okay, so that's it for this week. Thank you all for watching. Please, can you press like and subscribe to the channel? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.